We're starting today with a story that cuts straight to the heart of megacap tech's biggest unquantified risk, legal and regulatory liability. Needham and Company has stepped forward with formal concerns around Meta Platforms' proposed $18 billion settlement tied to child addiction and platform safety litigation. That is not a rounding error. For a company of Meta's scale, an $18 billion charge is a material event, and when a respected Wall Street research firm signals skepticism about a settlement of this magnitude, the market pays attention. The question now is whether this is a contained legal event or the opening chapter of a much broader regulatory reckoning for social media platforms and their advertising-driven business models. Needham and Company has raised explicit concerns about Meta Platforms' proposed $18 billion settlement covering child addiction and safety-related litigation. To put that in context, Wall Street consensus had been treating Meta's legal liabilities as a manageable headwind, modeling regulatory and litigation costs for large tech platforms at roughly 1 to 3% of annual revenue. An $18 billion settlement is well outside that comfortable band. Meta's shares trade as a significant component of both the Nasdaq 100, which sits at 711.37 this morning, and the S&P 500 at 766.08. Needham's intervention here is notable precisely because it disrupts that comfortable narrative, the idea that Meta's cash position insulates it from any settlement shock that the market hasn't already priced. The deeper concern here is not the dollar figure in isolation. It is what the settlement signals about the legal and regulatory environment surrounding social media and digital advertising platforms broadly. If Needham's skepticism proves correct, the $18 billion figure may not represent the ceiling of Meta's exposure. It could represent a floor. Child safety litigation has been building across multiple jurisdictions simultaneously, and a challenged or inadequate settlement can invite additional plaintiffs, state attorneys general, and federal regulators into the process. That dynamic transforms what looks like a one-time charge into a recurring liability overhang, which is precisely the kind of uncertainty that compresses valuation multiples on growth stocks. The 10-year Treasury yield sitting at 4.66% this morning means the discount rate for those future cash flows is already elevated. The most direct exposure sits with Meta itself, which carries heavy weighting in both the communication services ETF and the technology ETF. But the damage path does not stop there. Google faces collateral pressure because it operates similarly advertising-dependent platforms, including YouTube, which has faced its own rounds of child safety scrutiny. Amazon has consumer-facing platform exposure that could draw regulatory parallel attention. The Nasdaq 100 at 711.37 is particularly vulnerable because megacap tech concentration means a sustained Meta sell-off ripples through the index mechanically. The S&P 500 at 766.08 is more buffered by diversification, but still exposed. The VIX at 15.00 is subdued this morning, which means options markets are not yet pricing a panic scenario, creating asymmetric hedging value if escalation materializes. Traders need to track several converging signals over the next sessions. First, watch for any formal legal response to the settlement, a court challenge, a state-level intervention, or a new plaintiff coalition joining the litigation would confirm Needham's worst-case read. Second, monitor the Nasdaq 100 at 711.37 for any break below near-term support, which would signal that institutional desks are de-risking megacap tech exposure beyond just meta-specific selling. Third, the VIX at 15.00 is the canary. A move towards 17 or higher would indicate the options market is waking up to the scenario. Fourth, the 10-year yield at 4.66% bears watching in reverse. If equity risk-off intensifies, bond demand could pull yields lower, making duration assets like long-term treasuries a tactical rotation destination. Settlement clarity, in either direction, is the binary catalyst. Here is the single most important takeaway from this story. Needham's $18 billion settlement concern on Meta is not just a company-specific event. It is a regulatory risk signal for the entire digital advertising and social media ecosystem. If the settlement encounters complications, expect rotation out of megacap tech and into defensives and fixed income, a tactical the VIX pop, and multiple compression across the Nasdaq 100 names that depend on clean legal runways to sustain premium valuations. The market is calm right now, with the VIX at 15.00 and the S&P 500 barely moved at 766.08, but that calm reflects what isn't priced yet. That is the story driving the conversation on Wall Street today, and that is the full breakdown for this session. If this kind of deep dive market analysis is what you come here for, hit subscribe right now and tap the notification bell so you never miss a daily breakdown. Every session, we bring you the stories that actually move portfolios with the specifics that matter. See you tomorrow.